tuned in to The Andrew Lawton Show.
I do want to talk about ESG because this is something we hear a lot of: environmental, social governance. It's often done by companies that want to look woke and say that they're being progressive. And you see it tied in with things like the Sustainable Development Goals and all of these other things. And you often hear people sell ESG because every company wants a good ESG score. People saying that it actually is good for business too, that it's not selling out the bottom line, it's not negative to the shareholders. Well, a new study from the Fraser Institute casts doubt on that. It says there is not, in fact, any evidence supporting a positive correlation between ESG ratings and stock market returns. This looks at 310 companies on the Toronto Stock Exchange. The study author joins me now, Steven Globerman, Senior Fellow at the Fraser Institute. Steven, good to have you on the show. Thanks for coming on today.
Thank you for having me.
So for people that aren't as familiar with this, what is an ESG score and what are companies doing to boost their number?
That rate companies' performance along those dimensions: environmental activity, social activity, which is related to who you're hiring, how much you're paying your employees, and governance, which is related to how the company is run. And the rating agencies use different specific measures along those three dimensions, and then aggregate these measures to come up with an overall rating for a company. Companies pay for these rating services because, in part, they use it to promote their performance, their sustainability performance, just to use a broad term to cover those dimensions. Investment managers use those ratings to promote their ESG mutual funds and exchange traded funds to generate business from investors who are concerned about those issues when they place their money in different types of assets.
And you've looked at 310 companies on the TSX. You've looked at their stock market returns and find no correlation whatsoever, positive or negative, between the two, correct?
Well, let me just clarify one point, which is an important point. What we look at is the change in the ESG rating, and then we relate that to stock market performance going forward. And the reason that's an important qualification is that a stock price will change because new information about the company's ongoing prospects have changed. So the change in the rating is important because that really can be considered new information about a company's ESG profile. And if investors are really concerned about ESG profile, then it's the new information that they're going to react to. And yes, what we did was we looked at the relationship between the change in the ESG rating of across our sample of companies and the performance, the stock performance, which includes, by the way, dividend payments and any stock splits over the next up to 12 months beyond the rating change, which seems a reasonable amount of time to expect investors to react to that new information. And as you said, there's no statistically significant relationship, meaning any relationship we saw could be due to chance with relative confidence.
As we know, stock market returns themselves can be very fickle. They're often influenced by a company's profitability, but not exclusively so. And you're not looking at a company's financial. You're not looking at a company's profitability specifically. You're looking at the stock market return. So, have you, in other studies you've seen in the U.S., because I know this hasn't really been done in Canada, seen a relationship between changes in ESG scores and how much a company is making, one way or another?
Well, you're quite right that the focus of most of the studies, including our study, our recent study, is on stock market returns. But the reason you want to look at stock market returns is because you can't observe future changes in profitability looking at accounting statements. the stock market return, and particularly the change in the price of a stock, reflects what the broad, millions of investors think is the future profitability outlook for the company. So looking at the stock market, change in the stock market price is really effectively looking at expectations about future profitability, which are not observable if you look at accounting statements. Now, you might say, well, why not do a very long time series study and look at changes in future profitability? That could be another piece of research, but it's not just the stock price change. It's also, because many ESG proponents argue, it reduces the risk of a company. And so it's the risk-adjusted returns that you want to look at, and that goes beyond profitability. And we have controls for that in our study, controls for the risk profile of the company. So what we're looking at is the stock market's expectation of future profitability adjusted for expected risk.
One of the things that, and I realize you're a scientist, you're following the numbers here. You're not trying to, make the numbers fit a thesis, but there are going to be people that are very hostile to the ESG score and the whole regime there that say, okay, well, there's no point. And there are going to be people that are supportive of it that say, okay, well, it doesn't cost them anything, so it can't hurt.
Well, it does cost, and that's an important point. In fact, there was a piece yesterday in the Globe and Mail where a CEO of a small Canadian company was referencing the significant costs to his company of complying with ESG reporting requirements. So yes, the issue really does ultimately boil down to what are the costs and benefits of setting up a regulatory environment where all this reporting has to be done so ESG ratings can be created, if there doesn't seem to be a relationship between ESG ratings and the basically the efficiency performance of the company.
Yeah, and I think that's a very significant point. And you have, I mean, I've seen this covering the World Economic Forum meetings in Davos. You have all of these companies that are bending over backwards to meet these targets, and they're, integrating with all of these different agencies. And you've created this entire industry on ESG consulting and ESG, like all of this. And people are making huge money on this. The shareholders aren't, though.
The shareholders are not, and of course it raises an obvious question: why are people investing in ESG themed mutual funds? They're paying higher fees to invest in those funds. They don't appear to be getting the net returns that people who are investing in conventional asset categories. Why do they do this? And really, all you can say, I think, with any kind of reasoned analysis, is that there are non-financial benefits that are being realized by these investors, whether it's feel good that we're doing something good for the environment, or we're addressing income inequality or racial discrimination. That really is very hard to test. Surveys suggest that people do expect to earn higher rates of return, but they're not. And I think that fact needs to be made more widely known. If people continue to want to get psychic benefits or warm glow feelings from how they're investing, that's their business. But they should be informed about what the expected returns will be.
Very well said. People can check out the study for themselves over at fraserinstitute.org, ESG Investing and Financial Returns in Canada. And Steven Globerman, good to talk to you. I appreciate your time today.
Good to talk to you, Andrew.
Thanks for listening to The Andrew Lawton Show. Support the program by donating to True North at www.tnc.news.